Hello, member Tom Morrison here from the Metal Trading Institute, all the way from Nashville, Tennessee. We're excited to be here today with you. We're going to talk global economics, and the thing that is dominating the news right now is the Ukraine, Russia, and many other things. We're going to talk about that with Cliff Waldman. But before we get into Cliff, so just for your reminder, on the bottom right, you will see a icon called the chat. You click that, and to the right, you'll see there's a chat box, and you can type any questions or comments you want Cliff to address during this presentation. He's going to have a lot of stuff to share with you. So a couple of things before we get into that. We got 4 big things that NTI is engaged with right now, and you want to be engaged with. If you're somebody that travels to our meetings or not, you've never been, you're going to want to be there. So the first thing I want to let you know is that Furnaces North America, our ginormous trade show, over 150 to 60 suppliers, it's going to be a who's list. If you're looking for equipment, accessories, 60% of our members said in a survey they're looking to buy something this year. That is the place to be. It's going to be October 3rd through the 5th. You're going to want to be there. Lots of good content, education there. You can go out to furnacesnorthamerica.com to see all the latest out there on that. And registration is going to open in May. But the number one thing you want to do today or this week or as soon as you can is go out to the website, furnacesnorthamerica.com, and you want to book your room, the rooms we expect to sell out between suppliers and the attendees. The second thing is our NT Online Academy. Right now, it is imperative with new people coming into your businesses and growth that you have people trained as big as you can. And MTI's technical training is the #1 technical training site. It's ARP 1962. It meets all those requirements in the aerospace, automotive for CQI-9. It meets all the auditing bodies that audit your company. It meets their training requirements. You want to get your team on the MTI Academy. Very good stuff out there. And we just launched our Heat Treat Quality Specialist Certificate, which is really awesome. Midwest chapter meeting coming up next week in April 6th in Lake Geneva, Wisconsin. We're excited to be talking there with a speaker about inflation, long-term impacts of remote work, and obviously all the things going on around the country that's impacting our economy. And then our Great Lakes chapter meeting, if you're in the Great Lakes region, Ohio, Indiana, we're putting a meeting together on the June 8th and 9th that you're going to want to be a part of. It's going to have golf. It's going to have 2 great speakers on some great topics and in a great location that we're just about to figure out and finalize. So in-person meetings are back with NTI. Connection is high, and people are excited to be getting out and seeing their counterparts. So take a look at that. You can get all the details at heattreat.net, our website. You just go to heattreat.net and scroll down a little bit to the left. You'll see upcoming meetings, and there's blocks that have all the details for each of the meetings. So check that out. But today, we want to talk economics and world economics of that global, because we are also interconnected. That's what's creating a lot of the supply chain issues, is how globally we are connected when these countries go left or right, and we're going straight, and they can't deliver the goods. One of the big things you want to take advantage of is listening in to Mr. Cliff Waldman, who spoke to us in 2009, I think. Cliff, you spoke at our national meeting in South Carolina, and then you spoke at a couple of our chapter meetings as well. So Cliff, welcome to the MTI Live webcast. And right now what I'd like to do is for our listeners to give them a sense of your background and what New World Economics is.
Well, I am a professionally trained economist, undergrad and graduate studies at Rutgers University, and I began my career as an economist at the state government in New Jersey and dreamed of coming down to Washington to have a career down here. And that dream was fulfilled in the early 1990s, where I started my career with a small business research group at NFIB. And over time, I came to have 2 issues of expertise, 2 focused issues of expertise. As a result of the 15 years that I spent at MAPI, the Manufacturers Alliance, an organization I know you're very familiar with, and the great work that I had the opportunity to do there with a fine group of economics colleagues, I have developed an expertise in the economics of manufacturing. That and the economics of small business and entrepreneurship really have been my specialties in economics. Right now, I have fulfilled another dream of being an entrepreneur. I like that word. I have started my own business. New World Economics is a business that I think you'll understand provides economic analysis and data creation services for the manufacturing sector. And while that is most of my time, as I'm sure people who have done it can understand, I've been able to expand my world a little bit in that I was offered a position and I'm now in my 4th year as a radio DJ. I am on the the broadcast staff of a talk radio station, manufacturing talk radio. It is a once a month show. I sometimes broadcast myself. I very often have guests on the show. So it's kind of an old thing and a new thing. The old thing is just continuing on with my manufacturing expertise. My new thing is being a journalist, being a broadcaster, something I've never done before, but I must say I'm enjoying very much. And also I continue to be very active with the professional economics community here in Washington, D.C. I'm now in my third year of the board of the National Economists Club. So Tom, thank you very much for inviting me today. I'm looking forward to speaking to the group in at a difficult time, very dicey time.
So I remember the last time you spoke with us, it was in 2009, right after the banking smash, not crash, but smash. And I mean, lots of dynamics going on there. But what I love about what I just got out of what you said is you said you're an economist and a DJ. I love how you positioned as a DJ, not a broadcaster. Yes. It makes it so much more exciting, right?
Yes. No. We want people to see that. We want people to get the pulse and the beat of the business world.
Right. Awesome. So hey, let's jump into this stuff. So man, right now there is so much going on when you watch the TV, and you know, a lot of people are trying to figure out how big is it, where does it start, where does it finish, and how long is it going to be, and to what context is it going to grow or not grow. So tell us what the biggest risk that we're all facing in the U.S. and the global economics right now. What's the outlook for that?
Well, this has been a most unusual, even if you study the long history, economic history of the United States, this can only be seen as a most unusual and unique period. We've had a cascading series of crises, starting with the trade war in 2018 and 2019, a tragic and historic pandemic, an inflation surge that sort of, came out of both of them, and now a disastrous humanitarian crisis in Ukraine in the form of a war that Russia unnecessarily started in Ukraine. The two biggest risks for the business community out of all this mess is, number one, inflation. The United States is seeing its worst inflation surge since 1982, in 40 years. There are many people in the business world today, in the United States business world, that have never experienced or even know anything about what it's like to have an inflation like this. The second biggest risk is something that is exacerbating the inflation, and that is the tragic war in Ukraine. The war in Ukraine is making a bigger mess out of already distorted supply chains that came from the pandemic, and it's showing up in further exacerbation of price difficulties in key markets: oil, gasoline, commodities, food. Ukraine and Russia are wheat suppliers to large parts of the world, particularly to the Middle East. So we're going to have some problems there. So Ukraine and the tragedy in Ukraine exacerbates the inflation problem. And I must say, the inflation problem is not just the United States, Tom. The large parts of the Western world, the UK and Canada, are also seeing multi-decade highs in inflation. But Ukraine, because of the Russia sanctions and because of the tremendous uncertainty that it's causing, is also a threat to the global economic recovery and threatens a global slowdown. So two things, two big risks: inflation and Ukraine, but they touch each other and they magnify each other.
So when you talk about inflation, could you dig into interest rates a little bit? I know the Fed is looking to maybe go up 3 or 4 times this year. I mean, what's the impact of that? I mean, when you say that a whole generation doesn't know what inflation looks like, there's a whole generation that doesn't know anything over 4% interest rates either, right? So
right.
They don't have any idea that it used to be, there was interest rates of 15, 16, 17, 18% back in the 80s. So that's incredible.
We have had a long period of very, very long decline in nominal interest rates, nominal bond, that interest rates not corrected for inflation, just nominal interest. But inflation has been inflation has been so low for so long that I can even look at nominal interest rates as a correct trend, and they have just been falling. That has been good for our wealth. It has been a buoy to the stock market. But at this point, we are revisiting the early 1980s in terms of inflation. It's a little perspective. It's not as bad as what we saw in the late 70s. That was a dreadful period
Right.
for the United States. But it is the worst in 40 years. Now, the Federal Reserve is in a tough box. They had to, in March 2020, there was a panic that was happening as the economy as large parts of the economy were being shut down to try to stop the spread of a deadly virus. And the Fed had to make sure that economic health crisis, which generated an economic crisis, didn't also generate a financial crisis like we talked about in 2009. So they had to give it everything they had to, rail against a financial and an economic crash. Then the pandemic did lots of things to supply chains, mainly because of the labor shortages it caused. And the supply chains became gummed up. So we had very constrained supply from supply systems that just weren't working. You add to that large increases in demand. While people were home, they were demanding goods, electronics, and things like that at a rate we haven't seen in a generation. Government checks were also stimulating demand. So we had very high demand, very constrained supply, and that was the beginning of an inflation that could probably have been quashed, but the Federal Reserve has been late to the game. And the inflation started becoming viral. It became a part of the calculus of everyday economic thinking, everyday economic activity by business people and by consumers. Now we have a very difficult inflation problem, and the Fed's going to have to go a lot more than 3 or 4 times, a lot more than 3 or 4 times.
It was amazing during that period of time, though, what was running out. I mean, I talked to our pool supplier, and he said, Tom, I could put in 20 above ground pools in the middle of the pandemic, but he couldn't. They were all sold out. It was amazing, right, the types of things that were being sold out. So now let me ask you about the supply chain issues. Do you think the supply chain issues, as well as workers here in the U.S., but what about the interconnectivity because countries shut down and all the goods were going back and forth with countries? Well, they weren't going back and forth to countries. So I kind of feel like that just kind of was fuel to the fire of the lack of labor.
Oh, absolutely. Well, you have to understand first of all, let's talk about the complexity of supply chains. Mm-hmm. Given their complexity, it is a minor miracle that up until the pandemic that they have worked as well as they have. Nobody has thought about supply chains because they've just worked,
right,
so well. But U.S. manufacturing has call it a comparative advantage in the production of R&D intensive machinery, high tech, mm-hmm, R&D, but those goods are made in 15 different countries.
Right.
With each country having a cost and a comparative advantage in some part of the machine that is produced and sold. With the pandemic being a very much a global phenomenon and causing all kinds of distortions in labor markets, including, unfortunately, people just getting sick and not being able to do the job, we had the complexity of the supply problem that we had and the magnitude of the supply problem became as big as these supply chains are. Right. And that distortion is one of several things that has created this terrible inflation in the United States, but also in a number of other parts of the world.
That's a lot, man. I mean, hopefully we see, do you see any correction in that in the future?
I think eventually supply chain, well, we're going to have to go through a really rough period where the Federal Reserve corrects this. They're going to have to raise it. They're going to have to raise interest rates aggressively to try to bring demand in line with constrained supply. So it's going to be a rocky, bumpy ride while they do that. In terms of longer term supply chains, I think they will eventually correct, not this year, but maybe in the next year or two. By the end of 2023, we might start to see normal supply chain activity. But the bigger question is about supply chain decision-making down the road. I'm constantly getting this question. Are people going to say, I don't want my supply chains globalized. I'm bringing in the horns. I want more of a regional structure for my supply system. And they're really supply systems. Supply chains is actually kind of a misnomer. I'm sure your members will understand that better than I. But they are supply systems. But the question is, do I really want them global? With all this trouble, am I going to pull in the horns? Should I make them more regional? Is that better? And then the mode of production is changing too. Remember, we went to this lean, just-in-time method of production.
Right.
Well, that didn't work too well this time.
Right.
Because lean depends on minimizing work in process inventories. And you couldn't very well get away with that in a gummed up. That works when supply is working. But if it doesn't working, it's a disaster. And that gave us, among other things, that gave us the semiconductor tragedy, which caused all kinds of job losses, even in the auto industry. So I think supply chains will correct, take a couple of years. End of 2023 is my guess. But then the question going ahead is, what are the production systems and the supply chain decisions that are going to govern what supply chains look like in the long term?
Yeah, because if you look back at the just-in-time supply chains, it created another thing called empty shelves, right?
Right. Yes.
So
just in time may have to become just in case.
Right. Exactly. So the number one impact on people's minds, or actually the number three things on people's minds typically these days, are inflation. So what is the source of the rising inflation?
First and foremost is supply constraints. The problems with supply chains have meant that supply is not responding to demand. We had huge demand as we started to come out, at least the initial, about the really let's call it the pre-vaccine part of the pandemic. We had a large demand while people were stuck at home for electronics and things like that to make their home more of their world. So it puts huge demand for goods. When things started to open up again, there was a huge demand for services coming out. And then all this was catalyzed further by government stimulus, government checks. So it was collectively, the pandemic and everything we did in response to the pandemic gave us a huge surge in demand. Now you have a huge surge in demand and very troubled supply chains. All of a sudden, everything becomes relatively more scarce.
Right.
Because demand is up here, supply is down here, and all of a sudden that supply can be sold for a lot higher dollars than it was before. It's just more scarce. That gives you inflation. That gives you the first thrust of inflation. Now, we also had very big changes in our labor market here. I mean, labor market shortages are enormous now, the worst we've seen in decades. This morning, the job openings and labor turnover survey program with the BLS just about its latest data. There are 1.8 job openings for every worker out there looking for a job.
Right.
Great for workers, tough for employers. And in order to do something about filling these jobs, all of a sudden wages are going to come up, and you'll see that commensurate with the increase in inflation is total compensation costs coming up. I like to work here, but I have to pay my rent and my groceries, so I need more. I need more than you're giving. Or I'd like to stay here, but I can't afford it at this salary because all of a sudden food is 7% more costly, and that causes that looks like the beginning of a much feared thing called a wage price spiral, where wages and prices sort of interact with each other. And I think we're not quite at a spot. We're at an effect on each other. We're not quite at a spiral. The Fed may have caught it just short of that, but I think it's the interaction of wages and prices that are causing the Fed to say, hey, we got to jump in there with both feet and slow this thing down. Because once you get into a wage price spiral, then you have the late 70s. And that's, believe me, that's the last thing we want.
So what's the notion about, we have inflation, prices rise, and then all of a sudden everything corrects itself. We're getting back to some normality economic wise. Do prices come down? I mean, what's the experience been there?
Well, what will happen is correct. I think things are too tangled up to correct themselves these days. I think supply chains will correct themselves, but after a couple of years. I can't imagine supply systems really, they'll start to normalize up, to really correct themselves even this year. I mean, this year is going to go by fast. So I think a couple of years. And I think that the problem is that if the Fed just let things go and then let things happen by themselves, the inflation itself would cause a risk of a recession, because all of a sudden consumers will say, I can't afford this.
Right.
I can't go here. And all of a sudden the demand for goods would fall. Now, we have the risk of a recession, a non-trivial, I'll call it a non-trivial risk of a recession in the US anyway, because there's no question the Fed told us, and I was at that meeting where Chair Powell spoke at the National Association for Business Economics luncheon, and you had to see the look on his face. It was like 700 people in the room. You had to see the look of determination on his face. He came and basically said, come hell, he didn't say this, but he said, come hell or high water, I'm going to correct this inflation. And that's great, but also it can have an unhappy ending in the form of a recession. So I would say by the end of this year, early 2023, there is a non-trivial risk of a recession in the United States economy.
So when you say non-trivial risk, how? I mean,
yeah, everybody wants numbers. I would say that at this point, I mean, the Fed might pull off a soft landing, which is correcting inflation without causing a recession.
Right.
But it's dancing on the head of a pin now.
Right.
And I would say there's a 50-50 chance, maybe a 55-45 chance of a downturn in the US economy that starts roughly in the fourth quarter of this year. What's one of the things that your members are going to have to watch for? I know manufacturing has been very strong. That's great. They've been feeling it, red hot demand. But this inflation is the devil in terms of the short-term outlook. And I would not at least discount the possibility of at least a significant economic slowdown in the US economy and possibly being tipped over into a recession. Now, Ukraine, let's bring Ukraine to this. Yes, it exacerbates the inflation problem, gums up supply chain. We've seen what's happened with oil and gas and food and commodities as a result of the supply interruptions from the tragedy in Ukraine. But also because of the Russian sanctions, the uncertainty, Ukraine creates a risk for the global economy. Right. And that, as much as anything, hits US manufacturing. I'm concerned for the global economy in terms of the short-term outlook, the end of this year outlook, as I am for the US economy, because of course manufacturers and all parts of the supply chain are going to feel the impact of Ukraine on possibly slowing down the global economy. It depends on what happens with the war, of course. I mean, there's a lot of ifs there, but that's a risk to the global economy, global growth.
Well, I know you spoke a little bit about the labor issues and stuff, and I know what is the unemployment rate at, like 4.5% right now?
The unemployment rate is just slightly below, it's 3.8%.
So that's about what it was pre-pandemic. But what people don't understand, I think maybe if you could give them a little insight to this, is the labor participation rate is like 2% lower than it was pre-pandemic, which that's millions of jobs that are out there. And so if you could give people what's the definition of labor participation rate and unpack that a little bit, because
it's labor force participation. You are participating in the labor force if you are either working or out there actively looking for a job. Now, let's really go back. Labor force participation in a long-term secular sense peaked in and around 2000, has been coming down ever since. We are no longer in the post-World War II gains from labor force participation. Prior to the pandemic, it was kind of floating around, and then it fell in the pandemic, particularly female labor force participation. Most of that post-2000, a large part of the post-2000 was increase in labor force participation was female labor force participation. And now what happened is that labor force participation of females fell in the pandemic, and we're not quite up to where we were before. It hasn't been a huge bounce around, but it's been a negative. And that's one reason, that's one indicator of the labor market tightness that we're seeing, that's making it more difficult than ever for employers to fill these important jobs, to meet this big demand that I talked about.
Right.
and thus, creating upward pressure on wages.
Now, is the labor participation rate, is that I know it's above 16, but does it include retirees in that number, or is it people from
Now,
working
once
age?
you are once you are officially retired, you are neither working. I mean, if you're full-time retired, excuse me, you are neither working nor are you looking for work, and thus you are not participating in the labor force. Now, that the retirement issue was interesting. We think that the pandemic forced a lot of early retirements.
Yes.
The question is, it's just a question I'm going to answer, is whether or not a lot of those people are going to come back into the labor force. We need them to. We surely need them to. Whether they will or not depends on what employers do in terms of their relationship with their workforce. And one of the long-term effects of this historic pandemic is that you're going to see a very interesting changes in the relationship between employers and employees. Employees are going to be, first of all, besides the work from home issue, that's one thing, but they're going to be given more flexibility. They're going to be, be more on their own schedules. Everybody's going to. One of the effects of the pandemic is that every employee is going to be something of an entrepreneur, of sort of their own force within the company. And so we're going to have, it started a very different relationship between, I hate these old terms, but I'll just say between management and the workforce. I think it's unpredictable exactly where it's going to go, but it's going to be interesting to watch, and it's going to be different than it was prior to the pandemic.
Well, I mean, the reason I like to talk about the labor participation rate for a second is because when you say 3.9% unemployment, people think that's 3.9% of all the people in the United States. But when you say 3.9%, I assume that 3.9 is of the those that are looking for work or working.
The unemployment rate is unemployment as a percent of the labor force. The labor force is those people working, employed, plus those people looking for a job, actively looking for a job. The sum of those two is the denominator. That's the labor force. If you put unemployment, remember, unemployment's an active status. You're sitting at home on the couch and you're not picking up your computer, at least, and looking for a job. You're not unemployed. You're out of the labor force.
Right.
And it's all, I think it often gets misunderstood. You're unemployed if you are not working in a position, but you are actively looking for a job. So the unemployment rate is those actively looking for a job divided by the sum of those actively looking for a job plus those who are in a position, who are in a job right now.
Here's a $64,000 question for everybody listening in. What is the actual current labor participation rate number?
I'd have to look that up. I'd have to do some. It's not just a matter of looking it up, Tom. It's a matter of really studying the numbers to give you an accurate answer, a proper answer. Because I'll get back to your audience on that because I think we have to look carefully at those numbers before just spitting out numbers that can be misleading.
Right. Well, I mean, so I've looked up a couple different sites that track it pretty regularly, and it's 61.6%.
Right.
So if you just round it to 61%, the reason I like to unpack that number because now that tells you that 39% of America is not working or not looking for a job, which blows people's minds. They can't believe that 39% of our population is not in the workforce.
Well, one thing first of all, you said you looked on several websites. If I may suggest, the one and only source for that is the Bureau of Labor Statistics.
Correct.
They are the gold standard for that. Also, and yes, it's in and around 61%. But what I meant when I said I really want to study is that every year when it's revised, they revised it for population changes. Right. And they just did that, as a matter of fact, and that gets a little tricky. And also, we have to look at the issue of retirement, which is a complex one. So before I just looked in the hood, 61.2 and report, I want to take a closer look at those numbers. Yes, it's in and around 61%. But remember, That's 61, labor force participation. There's about, right now, there's about 150 million people in jobs. 150 million jobs, not 150 million people, because many people work multiple jobs.
Right.
So there's about 150 million jobs there. And then you have people who are not working, but who are looking for jobs. And then also another complexity with labor force participation, although it's waning, thank God, is the pandemic.
Correct.
Because BLS did the best they could. They had to really create these intermediate statuses that fed into the labor force participation rate, like furloughed, but home because of COVID.
Right.
I mean, these inconceivable things. And that too, made the trend of the labor force participation rate so difficult to really discern carefully. We can put it together, but it would take some time. So so there's a lot of complexity. And now remember, in terms of almost 39, whatever it is, 40%. You have retirees, you have people who are out of the labor force and are not counted, and that's been a concern for a long time. Alan Kruger, a brilliant Princeton economist, very unfortunately no longer with us, did a lot of work on for example, the impact of opioids on labor force participation. He saw that, and I think correctly proved that it too was impinging upon labor, and particularly the labor force participation of young males. So there's a lot that goes into that labor force participation number, and into just generally discerning the trend. And of course, short-term COVID created all kinds of new categories, and that's complexity in really talking about it.
Well, I just want to lift the hood up just a little bit to give people perspective that literally 35% or more of the population are not even in that workforce. So it's not the whole picture. It's a.
Oh, correct. That is correct. Yes.
So you mentioned the Fed Chair Powell's event you went to. So
correct.
I know you mentioned a little bit about some of what you took from that. So what are some of the other major takeaways it's great to hear from the guy that's at the top of the food chain in the Fed, looking to raise rates. What are some of the other takeaways that you came away with?
Well, Fed Chair Powell, throughout, inflation started really showing up in the data, fall of 2021. And at first he was talking about it being quote unquote transitory. Transitory has morphed into troubling. And this was the most hawkish, in other words, the most serious I've ever heard of him in terms of, saying that inflation is quote unquote much too high, and that we have to get on it right away. So it was the most determined I've heard him say in terms of talking about inflation. He tried to comfort us in saying, look, there's some historical precedent for being able to fight inflation without the hard landing, without tipping the economy into a big slowdown or even a recession. But even there, he admitted the risks. So it was certainly the hardest hitting that I've heard of. Fed chair have gotten poked fun at for being, for obfuscating, for using Fed speak, the language of obfuscation. But in all the years that I followed Fed chair before, Chair Powell, I would say, is the most is the straightest shooter I've seen.
Right.
He speaks very clearly, and this was, sorry folks, we've got a bad problem. We're going to try to take care of it without tipping this economy into a recession. But there's maybe even suggested there's maybe a little reason for you to be afraid. I got to tell you, I was very surprised. I've never, I would, short of Chairman Bernanke at the beginning of the financial crisis, I've never heard a Fed chair talk this alarmingly and this forthrightly about inflation. And it suggests that, they have to get on it, and that even under the best of circumstances, it's going to be a bit of a bumpy ride over the next year or year and a half for the U.S. economy.
Well, we've had multiple events periodically impact America's economy. When you look at the Russia-Ukraine crisis, labor crisis, and pandemic, and throw that all in a mixing bowl, it's just like the perfect storm of cost and pricing.
People are always asking me, give me to enumerate things, to give the three biggest risks, the four biggest, this, that, the other thing. But yes, we've had a cascading series of crises that really began with the trade war. By the way, the trade war it had impacted supply. It was the beginning of impacting supply chains. But we have had a cascading series of crises, and what it's important for people to understand is that while trade war, pandemic, inflation, and Russia, Ukraine are all significant events, they touch each other. They're not completely distinct. They touch each other, and by touching each other, they magnify each other.
Right.
Pandemic had a big role in creating the inflation. Trade war impacted supply chain, and labor markets impacted inflation. Russia, Ukraine is exacerbating the inflation problem globally, I might add. And all of this is causing a risk for a downturn in the US economy and maybe even the global economy. So yes, they're all distinct things, but they're more concentric circles than they are separate circles. And that's the way. It's important for people when thinking about the picture these days to realize that all these things touch each other and exacerbate each other in one way or the other.
Right. So switching gears a little bit, but not switching gears too much, as I know we've bobbed and weaved the Ukraine-Russia crisis or war in our talk. So is there anything else you'd like to unpack about any more current risks that are associated with that conflict that really plays on the U.S. or global outlook?
Well, I'll tell you, and listen, as of today, we've got, it's hard to talk about good news in this disaster in Ukraine. It seems like perhaps there may be, some suggestion of a bit of a drop down in hostilities, but frankly, I'll believe it when I hear it.
Right.
But I almost hate to say it, but with Russia, Ukraine, remember this is an event that's happening right on the doorstep of NATO. You can't ignore that. And, therefore, there's a risk of a mistake, of an attack that accidentally hits Poland, of a very frustrated Vladimir Putin, who is going to, is he going to use things that are unthinkable, chemical weapons, tactical nuclear weapons. The simple, whether any of this happens or not, the simple uncertainty of it, the very uncertainty of all these previously unthinkable things, and the simple fact that it's the worst war in Europe since World War II creates business uncertainty. Is this the time for me to invest? Am I going to do some interesting things with my supply chains? Am I going to put that new factory in parts of Europe? And remember, we also have uncertainty. To add to that, we also have uncertainty with China.
Right.
The role that China is playing in Russia, Ukraine, is exacerbating an already difficult kind of geopolitical tension that the U.S. is having with China. And at the time when the Chinese economy has been showing signs of slowing structurally. Now, when I say structural, I mean not just a normal slowdown that any economy has from time to time, but because of its demographic problems, its aging problem, because of consolidation and its overblown property markets, and a few other things, China's economy has been slowing for some time now. And of course, COVID is making all that worse. And they're going to have to get away a little bit from that zero COVID policy. It just doesn't work.
Right.
But China, even apart from COVID, China is seeing a structural slowdown. Matters a great deal to many manufacturers. Is that going to influence the Chinese government one way or the other in terms of its posturing on the Russia-Ukraine crises? Again, it's another risk, but all these risks touching each other and magnifying each other.
So what will be look out 3-5 years, what is the long-term impact of the Russian-Ukraine conflict?
Well, I think let's talk about what I think is one of the most important impacts for manufacturing is that however it turns out in Ukraine, whatever is the resolution of the disaster in Ukraine, the Western economies particularly are going to go back to a kind of Cold War posture on defense spending. Even if the Russia is push back out of Ukraine, or even if Russia takes Ukraine, all of a sudden we're going to be on a very different posture with Russia. It's going to be a kind of a reversion to a Cold War mentality. That means greater defense spending as a share of the economy in not just in the US, but in the Western world, with big implications for part of manufacturing. Also, apart from that, we're going to see supply chain realignments because of the pandemic, but maybe also because of the war. And apart from that, we're clearly going to have higher interest rates. We're going into a period of higher interest rates, and you add to that the slowdown in China, the clearly changed relationship between employers and the workforce, and a COVID problem that is not only smaller, but I think is going to be persistent. It's going to show up once in a while. All told, the Russia-Ukraine problem is going to be the most significant for manufacturing, more defense spending, and for those parts of manufacturing that would thus be affected. But then there's many other things in terms of higher interest rates, slower China, changing thinking about supply chains, changing alignment of supply chains. And it really is going to be a very new world for your members, for manufacturers.
So how long do you say the Fed raising rates probably multiple times? I mean, we know they're going to raise them 2 or 3 times this year. Do you suspect that 23 could be an extended version of that?
The probability, listening to Chair Powell, the strong, he insisted, look, don't set us on a predetermined path. The FOMC, the Federal Open Market Committee, which is the committee that sets the target for the short-term interest rates that they impact, meets every 6 weeks. It sounds like the median forecast is that every FOMC meeting, every 6 weeks for the rest of the year, we're going to at least have a 25 basis point increase in interest rates. So probably another 6 or so for this year at least. But that's the median down the line forecast. If inflation doesn't respond or gets worse, and it's possible, that 25 may have to go to 50. And in fact, some forecasters think that 50 may be a possibility for the next meeting or two. I'm on the fence about that because I think the thinking is a little more nuanced. But if Russia-Ukraine gets worse and starts to slow the global economy, and that starts to show slowing in the U.S. economy, then, they may have to hold off. So median forecast straight down the line, every 6 week FOMC meets, 25 basis points increase in the target for the federal funds rate, and the policy rate that they control. But there's lots of pull on both sides. There's pull toward 50, and if inflation doesn't respond and gets worse, there's pull toward holding off if Russia-Ukraine really impacts the global economy, and a global slowdown creates the early signs that I'm thinking of a U.S. slowdown. So they have their complicated time ahead of them.
People have made millions of dollars trying to guess that, right?
Yeah.
So
and lost millions of dollars trying to guess it too.
Well, one of our members said, so where do we see? I'm gonna actually let me save this question to the end, because I want to ask some business strategy questions, knowing what we know about what you're saying. So let's talk about the one thing that I think we've only said once the entire time, and I was like, man, I can't believe we almost got out of this meeting without saying it. But the COVID pandemic.
Right.
So some people think we're past it. Some think we're still in the middle of it. Some people think, we don't know where we're going. Kind of where's the economy lie in the structure of how the pandemic has begun to play out? Obviously, the numbers are super low and everybody's moving forward. Mandates are coming down and the economy is rushing back. Stadiums are full. Shopping malls are full. How are we seeing that cover?
Well, I mean, for a while, during the worst parts of the pandemic, it became very simple. The economy would go where the virus would go. If we brought the virus under control, the economy can come back. If we didn't bring the virus under control, the economy couldn't come back. It is certainly better in the U.S. than it is now. We cannot predict variants. We don't to try to predict whether we have this BA2 variant. It sounds like it's another kind of Omicron thing, but we just don't know. This virus is really been a new a new organism for us. I mean, it's really the thing is a wonder of evolution,
Right.
in its ability to change, and so we don't know exactly when and where new variants will pop up. So you have to allow for that uncertainty. The one bit of good news is that with every wave of a new variant, from the original to Delta to Omicron, with each wave we've handled it better.
Right. Absolutely.
We've been able to handle without the growth inhibiting lockdowns that we did initially. So we've adjusted somewhat to its presence. I would say right now in the U.S. that it's going to remain as a much lower level risk, or one that's always going to be sort of in the background. We get into winters and we have a COVID surge. There might have to be, we have to, put the masks back on. That would hurt, business and bars and restaurants and service-oriented organizations. It's going to change business travel. More, we're going to do more of this talking on Zoom than it is going to people getting on airplanes and seeing clients. So that it's going to have some change in business travel. But my best guess, and not sitting here and absurdly trying to predict, the course of a virus, but it seems to me like it's going to be a much lower level in the U.S., a much lower level, but still persistent risk.
Right. So let me ask the question that one of our members asked. So when we look at what we're looking at with inflation and stuff, where do you see some of the best places to put cash and or retirement investments? I mean, I know you're not a financial planner, but I mean, from your perspective, I mean, what are some things people could keep in mind as they're looking? I mean, the people that retired in the third and fourth quarter of last year, I mean, I saw what my investments did, and a lot of my friends' investments did in the first quarter of this year from the last quarter of last year. They were at great balances come December 31st. But in the last 3 months, so
Tom, I'm going to respectfully pull back because I have a rule, and I think it's a good one, about never giving investment advice. I think I hope I've helped people by sort of setting the scene and painting the picture here, but I am reluctant. There are people who are on Wall Street and in the financial community beyond Wall Street who are licensed to give investment advice. I'm going to be careful and stay within my lane and say that I think the picture I gave should be able to help you, but I'm not going to talk about anybody's portfolio. I don't think that's a good idea.
Well, I respect and appreciate that. What I will tell members is that this interview will be posted on our YouTube channel and will be sent out in our online forum, and you're able to forward it to your investment advisor and say, hey, I want you to watch this 45-minute episode of my industry trade group and hear what you hear, and then get them to offer you the investment advice that they would give, knowing what they've heard. Because a lot of people are, I know I am. I mean, I'm in that 10-year window, as many people are when they get over 50, of saying, I think I might retire. And you're thinking, okay, because money grows over time. So if it goes away a lot today, how do I recoup that over time? So I think those are all key things. But inflation plays a big deal in that. So our members are in the manufacturing process. They don't make anything. They service a piece that comes through their shop.
Right.
And so what are the last 2 or 3 thoughts, like the takeaways in the next quarter to a year? If you're going to do anything in the next 2 years, knowing what we've talked about, what is it that you'd want them to keep in mind? Is keep money in cash to make sure you muscle through a downtime, or extend credit? I mean, what are some basic things, if you've got any, that?
Well, they are in the early parts of the supply chain. The supply chain the supply chain matters to everybody. So, but they need to be sensitive to early supply chain signals. So you and I were joking around about just in time versus just in case. Mm-hmm. What I would do in this hyper uncertain world, in this world that we're going to have books written about, centuries to come, is for them to keep to keep inventories, to keep abundant resources of everything, to be prepared for twists and turns, to take your business planning assumptions that you would normally employ and put them aside and say, more than likely, I'm going to be wrong. So I have to keep more cash than I would. I have to keep more inventory than I would. I have to keep closer relationship with my customers and my suppliers. I have to keep my ears to the ground more. So more caution, more resources, put away the normal assumptions of business planning, and just assume that everything is going to be rocking on choppy waters for a while. That's the best business advice I can give them.
So it's pretty much changed the mentality from just in time to just in case.
Yeah.
And be conservative in that. So you've got the
Correct.
resources, you got the cash. If something happens, you can continue to flow business and service to your customer.
I'm happy to give advice, and there I would say absolutely critical to do so.
Awesome. So any final thoughts that you would like to leave? That was my last question. Any final thoughts you'd like to leave with our members as they pan out into this great economy we're trying to?
Well, of course, as always, I enjoyed speaking to the members. This is a time, where you really have to keep your ears to the ground. You have to keep I know you're going to tell me that good business always means keeping in close contact with customers and suppliers more frequently, more often than possible. Keep on top of the news. I know you always talk about keeping on top of the news, but every day there can be a surprise in Ukraine. Every 6 weeks there can be a surprise out of the Fed. Every one of them is going to rock their business and rock their supply chain. So ears to the ground, communication with customers, and excess resources of a just-in-case mentality more than ever, and they'll get through this.
Awesome. Well, Cliff, it's a pleasure having you again on our show. We appreciate you being here. Members, I just want to tell you we've got another edition coming on April 19th at 2 p.m. We will be announcing what that episode will be about in the coming weeks. So hope you can make one of our meetings in person, and we appreciate your membership because we're going to move through this time. We're going to all thrive together through here in 2030. So keep your head out, keep your passion strong, and the fire burning. Thank you for attending today. I will see you soon.